Most people have heard that investing is one of the best ways to build wealth. But everything you know about investing in stocks and bonds is wrong. Investing is the act of allocating resources, usually the money, which is called capital in financial terms, with the expectation of generating profit, gains, or income. More precisely, investing is putting money to work for a period of time in some sort of investment vehicles like real estate with rental yield, stocks, bonds, etc., to generate positive returns, that is, the profits that exceed the initial capital deployed. The core objective is to grow one's money over time, either in the form of income yield or price appreciation. The wealthiest people in the world didn't get that way by just saving their money. They invested it. Yes, they invested their resources in the asset classes to yield returns to build their wealth. So, where do they invest, and what are the assets they invest in to build wealth? Let's dive into the basics of some common investment methods. First up is stocks. A stock represents ownership in a public company. A buyer of a company's stock becomes a fractional owner of that company. Owners of a company's stock are known as its shareholders. Yes, they can be risky, as their prices can swing wildly and without warning. But remember, often the bigger the risk, the bigger the potential reward. Stockholders have two main ways to earn money. Number one, stockholders can participate in the company's growth and success through appreciation in the stock price. Number two, regular dividends are paid out of the company's profits. Dividends are portions of the profit paid out to shareholders, usually 1 or 2 or 3 or 4 times a year. The size of each dividend depends on how well the company is doing. On the other hand, capital gains happen when you sell a stock for more than you paid for it. If you sold it for less, that's called a capital loss. So where do you buy and sell stocks? The stock exchange. Brokerage firms help you trade stocks from exchanges. And these days, apps can bring the stock exchange right to your phone, making it easier than ever to get started. The second investing option we are going to talk about is something a bit more stable: bonds. Buying a bond is like loaning money to a company or government. They promise to pay you back with interest at a later date. The interest rate they offer is known as the coupon rate. Bonds mature on a specified date, which is when the issuer must pay back the bond's par value to the holder. Because of these guarantees, bonds are usually seen as a safer investment compared to stocks. Bonds have three main components: coupon rate, maturity date, and par value. The coupon rate is the interest paid to the bondholder, the maturity is when the payment is due, and the par value is what the bondholder receives at maturity. But for any investing to take place, there first needs to be a financial system in place. This system lets money be transferred between parties, savers, and borrowers. When you save money in a bank, you're actually lending it to others. Financial intermediaries like banks, mutual funds, and pension funds help move these funds from savers to borrowers. Now let's move on to other investing option funds. Funds are pooled instruments managed by investment managers that enable investors to invest in stocks, bonds, preferred shares, commodities, etc. Two of the most common types of funds are mutual funds and exchange-traded funds, ETFs. A mutual fund pools the savings of many people and invests the money in various stocks, bonds, and other financial assets. Mutual funds are not traded on an exchange, and their value is determined at the end of the trading day. On the other hand, ETFs are traded on stock exchanges, and their value fluctuates constantly throughout the trading day, similar to stocks. Both mutual funds and ETFs can passively track indices like the Nifty 50, Sensex, S&P 500, or the Dow Jones Industrial Average, or they can be actively managed by fund managers. Few more funds like a hedge fund is a private investment organization that uses risky strategies to try to make huge profits. But be aware that these investors usually already have a lot of money and understand the risks involved. A pension fund provides income to people after they retire, either after a set number of years of working or upon reaching a certain age. Sometimes, injuries can qualify someone for pension benefits. Employers set up these funds by collecting deposits, which fund managers then invest. Additional or alternate investment options include real estate. Investing in real estate can involve purchasing physical properties, property-based securities, real estate crowdfunding platforms, real estate investment trusts, REITs, and real estate mutual funds. Investors aim for both capital appreciation of tangible assets and stable operating income for ongoing cash flow. Next is commodities. Commodities are raw materials like gold, silver, oil, or agricultural products. Investing in these tangible goods can provide a hedge against inflation and market volatility due to their real-world uses and perpetual demand. For example, gold's price tends to be stable due to its various industrial uses and its status as a store of value. Next investing option is cryptocurrencies. Cryptocurrency is an emerging form of digital currency that is considered as an alternative investment. Although it may not provide a strong hedge against traditional risk-on investments, it has the potential for capital appreciation or passive income through staking rewards. Another investing option is art and collectibles. Certain investments like art, sports memorabilia, entertainment memorabilia, high-end watches, and other collectibles can also double as a hobby. These items may have historical or sentimental value, and their worth may grow over time as they become more historically significant. Next investing option is peer-to-peer lending. This involves making loans to individuals or businesses through online platforms that connect borrowers with investors. This type of lending has similarities to investing in bonds, but is conducted in more private markets and often involves higher-risk clients. While it has the potential for higher returns, it also carries greater risk. So far, we have seen some of the investing options available. Let me share a couple of valuable advice before winding up this video. Number 1, the best way to invest is to spread your money across a diverse range of securities. This helps reduce risk, especially when stock or bond prices fall. Generally, people put some money in more risky investments like stocks, bonds, etc., and the rest in more stable options like bank savings accounts, fixed deposits, mutual funds, pension funds, etc. The second best practice while investing is to start investing early. Time is one of your greatest assets in investment. The longer your money is invested, the more it can grow. You earn money on the money your money already made. That's the magic of compound interest. When you invest, two types of interest come into play: simple and compound interest. Simple interest is just based on the principal amount of a loan or deposit. Simple interest formula is P into R into T divided by 100. Here, P is the principal amount. R stands for rate of interest per annum, and T is the time. Compound interest takes it one step further and includes the accumulated interest over each period, so it's effectively interest on interest. The formula for compound interest is shown, where P is the principal balance, R is the interest rate, N is the number of times interest applied per time period, and T is the number of time periods elapsed. I can understand your reaction by seeing these formulas, but let's see how these work with an example. Suppose you lend rupees 1 lakh to a friend who agrees to pay it back in 5 years with a simple annual interest rate of 5%. At the end of 5 years, you would have rupees 25,000 in interest, making the total repayment of rupees 1,25,000. Suppose if you had agreed on a 5% annual compound interest rate instead, the calculations would be a bit different. Let's say the interest is compounded monthly, or 12 times a year. After 5 years, the amount of interest would be rupees 27,628, and the total amount repaid would be rupees and 27,628. This example clearly shows that compound interest is much more powerful than simple interest when it comes to growing your investments. When evaluating investments, it's crucial to balance the risks with the potential rewards. Generally, the higher the potential return, the riskier the investment. That's it I want to cover for this session. Always remember, investing is not just about quick gains, but aligning with values and aspirations to build long-lasting wealth. If you are seriously interested in pursuing your financial goals, then subscribe to our channel and also to our newsletter. We not only offer timeless advice on making and investing money, but also provide a vast knowledge of financial education to make you financially independent. So dive into the world of investments, stay informed, and take wise steps towards securing your financial future. Thanks, and see you in the next episode.